the wealthiest people I know are the most boring investors you've ever heard of. For me, I really try to go to the foundation of why are you investing? What exactly would, if you had this investment, what would that do for your life? Because if you have this huge why, then you're going to delay that gratification. You're going to not spend that money on some new Jordans, right? Or you're going to make sure and do a little bit more research because you're going to look at that money like something that you're trying to be a good steward of long term.
Investors, welcome back to the channel. Of course, another go round here of Masters of the Market. Joining me to talk all about investing, I am lucky to have with me today Professor G, NolanGouveia, who's actually a professor in the financial space. And I'm going to nitpick all of the in-betweens and the ins and outs of investing, whether it's dividend investing, growth investing, or as Nolan puts it, the bread and butter of ETF investing. So Nolan, first and foremost, man, I want to say welcome to Masters of the Market. I'm excited to get this interview underway. But my first question for you is, how exactly, Nolan, did you get started investing, and how did this really move and amass into your YouTube channel, which is very insightful by the way, for anyone who hasn't visited Nolan's channel, go check it out after this. And then, of course, how did you get into literally the space of being a professor of finance?
Yeah, man. First of all, thanks for having me on, Ari. I've been watching your channel for a while now and love what you're doing. So thanks so much for giving me this platform and having this conversation. Yeah, man. It's crazy. So to be honest, I never wanted to be a YouTube guy. I never I really think, not you, not me, but there are some cringy financial, things out there. And I just never wanted to be that guy. So, I mean, if we're going to take it back far enough, I actually never wanted to be a professor either. I really didn't like school. I went to school to play sports. I played soccer and football. That's pretty much why I went to school. But I really did love learning, and I loved business. I loved the idea of starting my own business. And so, right away outside of high school, I knew I was going to start my own businesses. I was in the health and fitness sector mostly. I was a personal trainer, and so I leveraged that into starting a couple vitamin shops, and then I leveraged that into starting a gym and had a gym for about 10 years. Just recently sold that, and I've done some health consulting, started a health app. There's been a lot of different things that I've done. And so with that, the university that I did go to knew that I was an entrepreneur. And so they said, hey, we're going to be starting an entrepreneurship program here at the university. Can you come teach a class? And I was like, I don't really want to, but I'd love to give back. So sure. So I went back, did it. And after a couple of classes, I just started seeing like, oh man, a lot of these students, their eyes are opening up in ways that I'm sure they're not opening up through their other professors, because other professors have a great perspective, but it's purely education, purely, book smart. And what I'm bringing was practical. It was what I was literally doing in my business yesterday, and I make a case study out of it. And so I saw the students' eyes open up big time, and they started gravitating towards that teaching style. And I started just seeing like, oh, wow, this could be a cool little mentorship thing. I don't really have that in my life too much right now. And so I'd love to do that. And so I pursued, got my master's, I'm like halfway through my PhD right now. Wow. And so I just love learning. I love teaching. But with that, I've been teaching full time now at a couple of different universities, but particularly at one, a couple of my students just said, man, the way that you teach personal finance specifically, but investing, when we go through the investing chapters, you really break it down in a way that makes me think that I could actually do it. It doesn't just seem like crazy numbers and tracking and all this stuff. And I think you would kill it on YouTube. And I'm like, I don't know. I don't know if I want to start doing video, and I had no idea. I didn't know how to even take a video. I didn't know how to edit for sure. That's not my specialty in any way. I'm not very creative. I'm pretty straightforward. And after about 2 years, honestly, of these couple students just saying, you should put it on YouTube, you should put it on YouTube, I finally was like, all right, fine, I'll do it. And my first 10 videos were just terrible, which I'm sure you went through the same thing. It was tough. I had 13 views, and 12 of them were my mom. So it's very, very tough to, get started. But just like anything else, I attribute it to sports all my life. It was you have a goal, and you're not going to hit that goal within a week. You're not going to hit that goal within a month. You're probably not going to hit it within a year. And so I just said, here, I'm going to control what I can control. And I'm going to make a video every single week for 52 weeks. And at the end of those 52 weeks, if I haven't done anything on this channel or people aren't tuning in, then cool, it wasn't for me. But at least I did what I could do, because I can't control how many subscribers I can get. I can't control how many views I can get, but I can control if I make each video just a little bit better. And so been doing that now for about 2 years, and the channel's been growing more so than any number, though. I really have a solid community of people that we talk to each other in the comment section, and been able to really help some people and watch some of my community help each other, which to me, I just love the win-win there.
Wow, what a story. I have to say, I've been watching your channel and you have a lot of insightful videos. Of course, I'm more dividend specific, but the reason I wanted to invite you on, right, to Masters of the Market and pick your brain about finance, because I feel like there's so many of us who are out there, first of all, who have a lot to learn from someone like yourself, who had literally, boots on the ground, entrepreneurial, work that you can actually bring to the table for us, tie it into business, tie it into investing. But even something that you just shared reminded me of investing, which was you are going to make a video for 52 weeks. It's a video a week, and you're just going to keep going. And that's the consistency. So I can already tell that the mentality there to teach investing is firmly grounded. When you see a lot of the students who are in front of you, I'm sure you're speaking to a lot of people day in and day out about finance and investing. What are one or two common misconceptions or mistakes that you see right off the bat that investors make?
Yeah, great question. There's a lot. There's a lot. But and the thing is, who I see day to day is a lot younger, right? Of a person. They're 19 to 22. So they're really getting started, really learning what investing is. And unfortunately, what they believe investing is kind of what they're seeing on TikTok. And they're looking for that quick win. They're looking for that, let's invest in something, and 1 week from now I want to sell it and make double my money. And if it's not that, then it's not worth my time. That's
Mm.
kind of the misconception that I'm seeing. And so kind of what we're talking about here is consistency, thinking long term, looking at starting with the why or the end goal in mind. That's something that I try to instill in everybody I talk to. But there's got to be a reason why you're investing. We're not investing for the money. Like, that can't be the only reason. Like, what is the reason? And at the end of the day, for most people, it's retirement. It's to be safe later on when you can't produce an income yourself, or when you don't want to produce an income yourself. You should have something there being able to make you an income. So that's a strong enough why to pick a safe investment that you're going to have for long term. If it's literally just to make some money, there's so many other ways you can make money. Investing isn't necessarily going to be the best bet. But anyway, as far as back to your question, with that, it's what's the quick win? That's number one. What's being talked about in the market? The other big thing that a lot of my students and just people in general try to justify is that they know something that maybe the market or these professionals don't know.
Mm.
So they're like, OpenAI just fired their CEO, and so this is going to happen, and so Microsoft stock is going to blow up, or it's going to drop, or whatever. And it's like, if you know about it, so does everybody else, and so do like these people that spend billions of dollars to know this information, or to even be the ones behind the information, are way out ahead of you. So I try to discourage day trading. I don't know what your views are on day trading, but for me, I haven't seen day trading work well. I've seen people make money off of it for sure, but I've seen more people get hosed and just lose life savings. Because of that situation, you get a little bit arrogant in the way that you do it, because you start winning a lot, and then you're like, well, cool, I'm just going to throw all of this into this trade, and then that happens. But anyway, I don't want to go down that rabbit hole, but those are the things that I see with my students specifically.
It's like that instant gratification, get rich by Tuesday, what I typically say, type of
Yeah.
mindset.
Yeah.
Interesting. Would you say that this quote unquote like boring investment strategy for those of us who are either, ETF investing or dividend investing is dead?
I wouldn't say it's dead. I would say that the people that are actually the ones that are building their wealth are doing it. It's just that those people aren't as loud as the people that are, talking about how they got rich off of this one thing, this meme stock or coin or whatever. And unfortunately, that's a very small percentage of what's actually happening. But if they're going to be the loudest about it, that's who's, most people are going to see and say, cool, I want that. Like the same thing with the lottery, right? Like when somebody
Sure.
wins a couple $1 million in the lottery, it's like, sweet, I would love that. But you don't hear about all the people that paid into that lottery that didn't win, right? So I wouldn't say it's dead, definitely not. The wealthiest people I know are the most boring investors you've ever heard of, and that's totally fine with me.
Sure. It's always said what boring is lucrative, right? And that's the
Exactly.
best approach. Which begs
Yeah.
the question, what type of investor would you classify yourself as? And can you talk to us a bit about your investment strategy, how you got started with investing in particular, and how you've kind of evolved over time?
Yeah, definitely. I'll start with where I got started with investing. I think it was kind of more so what my students get started with, which I think would be where most people find that allure of money in general, right? The idea that, compound interest can make you more money than the principal itself long term, right? Or you invest in something, it sits there for a little bit, and hopefully it should go up, right? If you're picking the right investments. And way more so than your regular savings account or even a high yield savings account, depending on the type of investment you do. So there was obviously a reason to learn about this stuff, right? And so when I started learning about it, I did definitely start with, oh, I really like this company. Like I liked Disney's CEO back in the day. I like what Apple was doing. I like these types of companies. And then as a business professor, I knew a lot about these companies. I did case studies on them. I knew what their competitive advantage was. So I knew a little bit about their moat and how they, probably won't get taken out of the market, and that it's a smart, sustainable company and blah, blah, blah. But after a while, I started really learning like, okay, what are the most wealthiest people investing in, and reading books like a Random Walk Down Wall Street, or The Richest Man in Babylon, or Rich Dad Poor Dad, or any of these types of books, and just starting to see, while some of them don't invest in ETFs or index funds, what they're doing is building out a portfolio that is very similar to an ETF or index fund, where it's diversified across different industries and different reasonings to pick each and every one of those companies. And so what I saw was, okay, I could do that. I could, be a lifelong learner and just learn about each one of these companies and put together my own portfolio, or I can look at what has the market done over time. And so I looked at, the S&P 500, or some of the different growth ETFs like QQQ or SCHD, or some of these other ones. And I just looked at, okay, what companies do they bring in? How are they structured? How does it work? And I started to see, okay, if the S&P 500 is going to bring on average, 10, 11%, even through on average through bad years as well. And then if I were to pick my own individual companies, maybe I would beat that a little bit sometimes, but maybe I would get crushed sometimes. I looked at it almost like a cost value basis type analysis, where it's like, for my time, it's worth it a little bit more for me to just pick solid ETFs and index funds that I know are going to do well because of the data that I've seen for 50 years. And I trust that. And I would rather give up a couple basis points of possible income to have more time. And so for me as an entrepreneur, my thing was always not to build a business so that I make a bunch of money. My thing was, I want to have time freedom. And that was always the idea. Even as a professor, I love this job because I have a schedule where I can pick and choose how I do my classes, and then I have more time freedom to do what I want to do. So same thing with investing. For me, I picked a type of investing where I have a little bit more time freedom. I know that you do a really good job of picking individual stocks. I've seen all of your picks and they're great. But for me, I don't want to spend hours and hours daily to look through all of that kind of stuff. And so for me, I like to pick something that I can set and forget to a certain extent. I do obviously do the research, weekly or monthly, but I'm just not in it in the trenches day to day because I don't have to be. And it's brought such a stress-free way for me to invest. And over the 15 years I've been doing it, I'm up a lot. And so I'm very happy with the choices that I made. So as far as what type of investor I am, definitely ETFs. I would say my portfolio is 92% ETFs, and then very, very small amount, just a couple blue chip stocks. Very, very boring. But very much so. on my channel, I talk a lot about my 3 fund portfolio, which is a little different than like the Boglehead's 3 fund portfolio. I think it's an updated version, but the 3 types that I like is a foundational ETF, like the S&P 500 or the US total stock market, something foundational. It just has a lot of history, should be in your portfolio. Number 2 is something safe, and something safe back in the day used to be bonds, but I think a more updated version of bonds is going to be dividend investing. So value type companies, something that's going to produce a dividend, but it shouldn't be super volatile. It shouldn't drop 20%. It's probably not going to go up 20% either. And so for that, I like a dividend ETF. And for me, I really like SCHD, but I also like VYM and a couple other ones. And then last is something a little bit higher risk and a little higher reward. And back in the day, that used to be international exposure. But nowadays, companies are just so globalized that especially the US companies, they're taking market share all over. They're not just in the United States. So I'm not going to be, picking other companies that are supposed to blow up just because they're in India or China. I just think the US, once they see there's a market there, they take it over. And so for me, I'd rather go with a growth ETF at that point. And so that's a little higher risk, but much higher reward, as we see, QQQM and SCHG, they're up over 40% this year alone. And so that's high enough for me. So those are the ones that I pick for that.
It's a great returns. Yeah. Good enough for me as well. This one I'm going to toss out to you to put you in the hot seat, as I like to say, and you can ballpark this one. What right now is the value or the total there of your portfolio?
Okay, including real estate, crypto, like everything, or just
Oh,
equities?
we could get into that in a second. We'll go just with the stock portfolio, and then we could break it all in there, and then your real estate portfolio and crypto as well.
Yeah, just equities, I would say 400, 500,000. Yeah.
And then throwing in real estate.
Uh, like 1.2 or 1.4 million.
Wow. And then I know you're going to come out with the Bitcoin number of like 3.5 million.
No, my cryptocurrency holding is very, very small. It's just like what I recommend for people, which is 1 to 2%, nothing really. But I would say like 40 or so grand of that.
Wow.
But the amount that I actually put into it was in 2013 or 14. So I put like 5,000 of total in there. So it's grown a lot. But again, it's something that I believe that Bitcoin, there's a space for Bitcoin at some point. I don't really believe in the other cryptocurrencies too much anymore, but I do believe that blockchain specifically, the technology for that will be used. I just don't know how. So I have a little bit of exposure, but I'm definitely not like a crypto head.
Entrenched in it, sure. I have to say there's always the doers and the sayers. And when it came to, like you shared, a lot of professors, right, who are teaching, they don't always have that experience. And now, like, I want to come full circle and say, here we are. And you're talking about your portfolio, you're talking about the real estate, right? And the crypto portfolios as well. And it really just goes to show that with experience, right? And I like to say the University of Hard Knocks, no one out there needs to pay for a tuition now to get this special class with Professor G.
Yep.
But I want to toss this one out there for you now. When it comes to just starting, to invest, how should we all go about investing? Should we first start with ETFs? Because you do have some blue chip players in your portfolio. Should we start with individual stocks or head right into ETFs at first?
I mean, that's a great question, and I'm going to answer it like a professor would and just say it depends.
Sure.
That's the answer for everything. I think, but honestly, each individual investor should be an individual investor and be different than anybody else. Like, though I do have a portfolio that I believe is successful, I don't think it's the right one for everybody. Just like I believe Warren Buffett is quite successful, but I'm not going to copy specifically what he does. I'm more so copying his strategy or his mindset around what he does. And so that's what I try to do on my channel is I explain the things that I like, I explain the things that I'm in, but I also explain why and what I'm thinking when I'm trying to, pick these things, or what I'm thinking when the market drops and everybody's freaking out. So more so just trying to understand the strategy behind it and build up a good mind so that you can make your own decisions. As far as what I think is just a blanket, for pretty much everybody, I think that you should start with just a very foundational, very much highly understood, lots of data, just an ETF or index fund. And the two that I would start pretty much anybody with are the S&P 500 or the total US stock market index. Either one of those, there's just so much data, specifically going through other recessions. When I talk to really wealthy investors, they don't really invest to make monster gains. They invest to make sure they don't have crazy losses. And so instead of making money, they're trying to make sure they don't lose money, because we're losing money if it's just sitting in your bank account, right? Inflation's eating that up. So if we can beat inflation, double that percentage if we can, then we're ahead of the game. And if you can do that consistently, you're going to beat 99% of investors. So all that to say, I know this was a long, professor winded answer to your question, but I would just stick with the tried and true S&P 500 or the US total stock market.
Sure. And is there anything then we should be doing perhaps before we even get to investing? Because, I know on
Totally.
my end, what I started with was actually making sure I didn't have any debts. That was important for me. But
Yeah.
are there any pieces of criteria here that you could list for us that before we even get to investing, here's where we start?
Yeah, and that would be actually where I'd go, because I do hear that all the time from most students or most people is, what should I invest in? And I always bring it back the same way as when I do consulting for businesses. They say, here's the problem, what's the answer? And then I say, okay, let's make sure that's the problem. Same thing with, what should I invest in? Well, first of all, should you even be investing? And that's great that you brought that up. And so totally 100%. Number one should be, in my opinion, I like, Dave Ramsey's number one, which is have an emergency fund, have something that's just solidified, safe, because things happen. Things happen all the time. You could blow out your tire and it would cost you, $200. And if you don't have that, you're going to put it on a credit card. And then if you can't pay off that credit card, you're going to now have interest. And now you just dug yourself into a hole. So there's no reason for you to be putting that money into investing. So I like to build up an emergency fund of something substantial for you. For most people, $1,000 is pretty substantial. It's a nice safety net. So that's where I start, or that's where I tell people to at least start. Simultaneously, I would say paying off high interest debt for sure. Though the high interest debt should be paid off, and that should be the most important thing, I still think an emergency fund should be first, just so that you don't add to that debt. But could be somewhat simultaneous. So high interest debt, anything over 6% is what I say. So most credit card debt is, near 20% interest. Personal loans, any of those types of loans. If it's student loans and they're like 3%, or like even a mortgage that's 2.5, 3, 4%, I'm not paying those off any faster, but to each their own. But that's where I'd go. I'd have both of those going. Then personally, I would rather you start to have at least 1 month's worth of living expenses in a high yield savings account before even starting to throw too much money into investing. Again, we're trying to build up the safety, and especially over the next year, it's going to be quite volatile, with everything going on, the political climate, everything going on around the world, as you know. There's just so much that could move these markets and mess with your money. You want to make sure that you have at least a month, but long term, I like 3 to 6 months worth in a high yield savings account. And then at that point, then you can start really throwing all the rest of your money into investing. Like there's no reason not to, because you have enough safety on the sidelines that it just starts to become really fun. You can just throw your whatever disposable income you have into some investing and take advantage of some big dips that I think we're going to see over the next year.
Sure. Now, here's an interesting question for you. And I've actually seen this question posed on different channels. Like I said, I'm not a real estate channel, but I'm a dividend investment channel. So, when I look at, a lot of different channels, and I sometimes go through the comments specific to real estate channels, or I had Kevin Burgess on not too long ago, whom you may know. And
Yeah.
we got to talking about real estate. And one question that seems to always pop up is, should we get into real estate? Should we chuck the stock market aside? Why should we be invested into the market as opposed to just diving right into real estate?
Yeah. I mean, that's a great question. I have seen my net worth go up a lot because of real estate, but it was dumb luck. Like I got invested into real estate, a couple years ago, and then COVID happened, and then for some reason, all properties just went crazy through the roof, and it doubled my net worth within a year or so. Like it was insane, but it was nothing that I did personally, and it doesn't really make sense, to be honest, but it just happened that way, right? And so I
Sure.
can't sit here and say, yeah, go do this because that's going to happen, right? What I can say is I understand how businesses work. I understand that they're always incentivized to make profit. If they don't make profit, they don't stay open. And if their whole goal is to make profit and you're invested within them, then they are working for you. So there is obviously incentive, sorry, to make that profit for you as an investor. And at the end of the day, I just am big on multiple revenue streams, multiple income streams, and specifically diversification outside of different asset classes, right? I think a lot of people do a really good job of diversifying within stocks, but at the end of the day, that's still just stocks. And so I think having one or two other asset classes, just in case the entire market drops, which it does drop pretty, it's correlated pretty well to each other. And so if we can have a different asset class that maybe increases while others drop, that's a smart move. So the other thing too is real estate is much, much harder than YouTubers make it sound. YouTubers and TikTokers and real estate agents will tell you that it's the best investment whatsoever, and you can just all you're going to do is get rich. And it's like, yeah, you can make some money for sure, but it's work. Like my rental properties, especially my short-term rental property, is a lot of work. Airbnb is more work than it seems, even if you're going to offload it to a company or to a certain, cleaning crew or whatever it is. It's still a headache talking with your customers or your clients and then making sure things are correctly done up, or it's just on your mind all the time. So
Sure.
there is a trade-off with stocks. It's not really the same thing, even though you are invested in these companies and you should be doing your research. It's not like you're sitting there going, well, I hope the CEO makes this decision, maybe I should give him a call and we should talk about this. Like there's nothing you can do about it at that point. And so all that to say, real estate's great, but do your homework. It's a huge decision. It's a lot of money up front, a lot more than most, investors are used to putting into an investment right away. So yeah, it's good, but not the only thing you should do.
Sure. So we'll table real estate for the time being. We'll
Yeah.
catch you on another Masters chat and double down on real
Yes.
estate then.
Yes.
I'd love to
Especially with
understand. Go ahead.
sorry, no, especially with the rates where they're at right now, it's tough for me to sit here and say go for it. I've definitely been one to say, date the rate and marry the asset itself, but we just don't know if those rates are dropping or going to drop. In the next year, 2 years, you're going to be hurting for a while. So just be careful.
Be patient. I always say it pays to be patient. That's
Oh yeah,
patient with a PAY.
I like it. I like
But
it.
it's so important as an investor to be patient, and that leads me to the process. And I want to ask this question to you: What is what's your process like? What does it look like? Because first of all, if you could share some of the blue chip players you have in your portfolio, be
Yeah.
curious to know, and then why those blue chip stocks. But what was your process in adding them to your portfolio? How did you know that those stocks were the ones to add? Can you talk
Yeah.
to us about that process?
Yeah, definitely. My process is quite involved, but it's different than most people who pick stocks. I pick stocks almost exactly like Warren Buffett picks stocks, which is he understands the company. He does not necessarily look at the fundamentals. I mean, he does eventually, but definitely doesn't start with just the numbers, just the fundamentals, just any of those types of things. In my industry, it's the numbers and things are quantitative, and then the competitive advantage, all that is qualitative. And so when I'm doing research, I want to do more qualitative research in whatever I'm doing, but specifically for stock picking, it's qualitative. It's a lot more of the why and the how and that type of situation rather than the what. And I think a lot of people just look at, okay, what's the dividend yield and how much has it gone up per year, and where is it relative to where it was a year ago or 2 years ago? And those are great metrics for sure. Those almost for me help disqualify a stock. So I'll look at those very quickly. And if it's just too many red flags, I don't even continue to look at it. But if it's like, okay, those numbers look nice enough, then I start to look at, okay, what has the CEO been doing over the last 10 years? And what does the board think about these decisions, and how do they come up with, the way that they run the company, and who's in line to take over the company, and how do they hire, and what's their competitive advantage? What's their positioning compared to their competitors? So I really do look at it like a business professor geek, but I like to specifically look at metrics that other people probably aren't spending the time to look at. And so the types of companies that I pick have just an amazing competitive advantage, almost so much so that they don't have a competition. Like, you could really sit there and say they are so far ahead in what they do that for somebody to even get close to it, the barrier to entry is just insane. Somebody could enter the market or enter their industry, but they're not going to be literally competing head to head with this company. And so for me, my top four players would be Microsoft and Apple, which I believe are different. A lot of people would put them together in the technology space, but they do totally different things. Microsoft specifically is my biggest holding, and that's a new shift. And the reason why I like Microsoft so much is they're just so far ahead in things and technology that we're going to use 10 years from now. Apple is crushing it today, and they're going to continue to crush it. They'll always be, amazing, but they kind of, in my opinion, they've taken the foot off the pedal a little bit, and that's okay. You can do that at the 2 trillion, 3 trillion valuation that they're at. They more so have to sustain and keep making great products. Microsoft is looking way to the future, especially with AI. They're so far ahead in that regard. They also have such sticky products that people have to use. They have to continue using Microsoft stuff, and they don't even know they're using it half the time. So those are those two companies. Next would be Disney, and Disney right now is all over the place. I really like their just all the different places that they have business going. Specifically theme parks, obviously nothing's touching that, but that's not their biggest form of revenue. When they started getting digital, and having, Disney Plus and the amount of subscribers they have there, they're crushing it in that regard, but they haven't even started to use that technology at its highest yet. I believe that eventually will be big. There's a lot of politics and different things going on with that company, restructuring a lot of things. So it's not the greatest right now, but it's also a good value, in my opinion, to be buying in. And then one of my biggest holdings is then Berkshire Hathaway, because I mean, Warren Buffett, I don't really need to say much more, but the holding that they do, the amount of cash that company has on hand at all times, very, very smart, very, very patient, PAY, patient, and just strong company. And the thing that I love about Berkshire Hathaway is that Warren Buffett is a great investor, but he's an even better leader. And I believe that he's set up his successors to absolutely crush it. And I know people are very worried that, he's going to pass on soon because he is very old. I don't think that that's going to be a problem. I think that he has set them up so well in the things that I've read and watched. And I just think this company is going to continue to be a behemoth and might even start making some riskier plays that might have higher rewards down the road.
So very bullish on Berkshire Hathaway.
I
You
am.
know,
Yes, I definitely am.
it's interesting because all, whether it's Disney, Apple, Microsoft, some might say that Apple and Microsoft aren't necessarily dividend stocks, but they do pay a dividend. I want to ask you this question because you're not necessarily a dividend investor. You're the ETF, classified ETF investor. But is a dividend a good sign when a company's paying out a dividend? Because some people say, why get invested even into dividend stocks? But yet here you are with all your blue chip players paying a dividend.
Yeah. And Berkshire doesn't. But I do think that paying out a dividend, I think that is good. I think that's a good sign of a company, because I mean, if we really boil it down, that means that there's some extra money, that so much so that they don't even need, that they can give out to us, right? Like, if we really, really simplify it. So that's a good sign for me as a investor to be investing in a company that has disposable income to a certain extent, right? And so, yes, I do believe that that's a good sign. I don't necessarily think that that's a overall 100% need, because I do believe, Warren Buffett, he literally says we're not going to pay a dividend. He has the almost the most cash on hand, right? As far as a company, that company has billions and billions just sitting there. They could give out a dividend very, very easily. But what he says is, I'm not going to give back a little dividend and give you the money. I'm going to use that money and continue to grow your share for you. And he's made good on that promise. Berkshire Hathaway has consistently beaten the S&P 500. So I believe that if it's somebody so smart and strong like him running it, yeah, I'll let you take my dividend and invest it for me. Like I'm totally okay with that. I don't think all CEOs should have that power, and they haven't earned it yet. But that's kind of what my thinking is for that. I do prefer a dividend, of course.
Sure.
I would love to have I love the cash flow, love the passive income. One of my biggest holdings by far in my entire portfolio is SCHD, which is a dividend ETF. So I'm definitely am a dividend investor, just not so much in the trenches like you.
Sure. Yeah, no, look, I saw one of your last videos regarding SCHD and another video living off dividends, right? That's what initially tied me into the Professor G channel there.
Yeah.
But what pulled me in also, right, is your perspective on a lot of things, which we just got a lot of. And something that was very interesting that I spotted, as you know, noted just as you were speaking, was how you were talking about your process involves a lot of qualitative, right, if you will, analysis versus the quant side. And that's
Yeah.
interesting to me because you're coming with experience, and you said you look to a lot of the leaders, right, of these companies, the management teams. Now, for me, I have really these three pieces of what I like to call the Buffett, pieces of criteria, whether it's a good management team, a great brand name, right, that reputation, and a clean balance sheet. What would you say? Because again, if we go back to kind of what we were first talking about, where a lot of investors are going wrong with this get rich mentality, they kind of do look at the numbers first. How
Yeah.
can we help investors out there realize there's a necessity to slow down and really go towards that qualitative side or aspect of, and analyzing a business?
Yeah. I mean, it's tough, man. To be honest, it's very, very tough. I've seen this building health and fitness businesses as well. You have people that their goal in their mind is to lose weight or to gain muscle. But really, we have to, show them like, okay, what is the actual goal? What is
Mm,
at the end of the day, what are we really doing this for? And it's longevity of life, right? It's health. It's so much bigger than losing a couple pounds, because if it's just losing a couple pounds, that's not enough for you to put down that brownie. Like that's not a big enough why. And so for me, I really try to go to the foundation of why are you investing? What exactly would, if you had this investment, what would that do for your life? Because if you have this huge, huge why, for most people, it has to do with their kids or their grandkids, or helping out, giving back to the church or something where it's so big that it's bigger than you, then you're going to delay that gratification. You're going to not spend that money on some new Jordans, right? Or you're going to make sure and do a little bit more research, because you're going to look at that money like something that you're trying to be a good steward of long term. You're not trying to, well, it's okay if I risk this because the reward is so high. No, it's not okay if you risk it, because if you lose that money, now you don't get to give that money to your kids. You don't get to use that to help your parents later on when they get older or whatever it is. And so having a big enough why will make it so that you can understand the seriousness of why you need to take a little more time and actually do the research, and understand what you're investing in. So that's where I try to go. I try to figure out that, because until somebody says it's so important to me that I'm going to do the work, they're not going to do the work, and it's kind of pointless for you to beat your head against the wall and say stop investing in that penny stock.
sure. I want to ask, what if you mind sharing, what is your why?
Yeah, I mean, my why honestly is that there's a couple different ones. And so number one is time freedom, right? Time freedom has always just been this thing in my brain. I want to be able to do what I want to do when I want to do it. And that is not sit down on a beach and just chill. Like I think that I'll be working forever, but I want to be able to say when I'm going to work and what I'm going to work on. So that is like the big overarching why. But another one is just to give back generously. Like I love, absolutely love helping people. That's why I do what I do in everything. That's really the core of why I started my gym. I wanted to be walk people side by side and get their life healthier. And that's why I teach. I don't teach for the salary. So I teach because I want to help these students, because I think that these students are getting a perspective from their other professors that's great, but not necessarily as practical. And there are other professors that teach from my school of practicality, but not a lot. And that's okay. The students just need to be well rounded. And so I want to give back in that regard. And then I just absolutely love blessing people with a gift of, financially, if I can. And not everybody needs money, and that's not necessarily, the end goal. But if I have a friend or family, or some random person, and they're just telling me this story, and $100 is going to totally change their holiday season, then I'm so excited that, like, wow, I'm blessed with this money. I can give you some, and we can, hopefully I can help out in some regard. So I think that there's a big case to paying it forward there.
Wow, that's incredibly inspiring, special. And what I've just been noticing all throughout already our chat, as well as all your videos, right, is the genuinity that you bring forth. And I can really appreciate that, admire that. I think we need more of it. And of course, I'm sure a lot of your students recognize that. Now,
Thanks,
with
bro.
this next question, and it's abundantly clear all the experience is there. So you've certainly learned a whole heck of a lot throughout your journey thus far. And I'm curious to know, knowing what you know right now, based on all your experiences, looking back, what is one thing or two things, if you have them, that you would tell your younger self to, when you get started, do X, Y, and Z?
Yeah, that's a very, very solid question there, rooted in wisdom. I like it. First of all, thank you for saying what you said. I feel like the more that I learn, the more that I feel like I don't know. So I think that that's been interesting, growing up a little bit, and becoming a little more wise. You start to see, like, oh man, I didn't know anything back then. So I'm glad I made it. But I appreciate that. As far
Of
as
course.
telling my younger self possibly some things to do or not do, I think I would spend more time in research. Honestly, I feel like I did do a good amount of reading and learning and watching channels like yours or mine even. Um, but the whole idea of measure twice, cut once, like
Mm,
that whole idea makes so much sense in all areas of life. And I think my way of doing things, since I do have an entrepreneurial spirit, is know about 20 or 30% and then go for it. And I think that with investing, that could be detrimental. And I did lose money in certain things. It did teach me, very quickly, like, oh, that fire is hot. I don't want to touch that anymore. So it did teach me quickly. But had I just done the research myself, earlier, I think I would have learned it just as fast without having to pay to learn it. So all that to say, more research was a big one. I think seeking out other people would have been another thing too. I do a pretty good job of that, but I think that I want to come to the table acting like I know so that I can speak the language. But what I've seen is, if somebody comes to me and they know nothing, I'm just so happy to explain some stuff to them. And I know that you're the same way, Ari. And I know that, for those of you out there that are totally new to this or don't necessarily understand something, I would so much rather you hit, Ari up or hit myself up and just ask, like, what does this mean? Like, I know that you guys always talk about this dividend yield. What does that even mean? Or what's an ex dividend date? Or, these types of things. You may feel like your question is elementary, but it's definitely not. Like, we would rather just help you learn it, and then you be a better investor because of it, and that would make us so happy. So those are the two things I would say: research, and then seeking people who are just a couple steps ahead of you out, and just buying them a cup of coffee and asking them some questions.
sure, great answers. Now, another one here for you is just when you're at the beginning stages of building an investment portfolio, I think a lot of us can get caught up in how big is too big, right? Is it better to have a smaller portfolio with, maybe a handful of solid, high quality companies, or on the other end, to overload yourself, with 70, 80, 90 plus, stocks. This is a big debate. I want to get the professor's opinion.
Yeah, yeah, and I have a very strong opinion on this one, and I would actually like to hear your opinion too. But in my opinion, I say less is more. I mean, my whole channel, I mean, it's literally called Investing Simplified, and the whole idea is to simplify your holdings and simplify what it is that, I would rather put more money in less places and just build those up. And so that's why I'm such an ETF investor, because if you think about it, like, yes, I only have three or four ETFs, but within each ETF, I'm touching thousands of companies. And so at the end of the day, I guess my portfolio is thousands of companies big, but I'm only concerned with and putting money into three or four different places. And so, other than my individual stocks, like I said, which is a small portion of the portfolio. But all that to say, I think that I've seen more people get confused and burned out when they have 70 or 80 places to place some money, because if you're only able to invest, $100 a month, it's like, oh, I'm never touching some of these holdings. And so it's like, why even have it there? But that's my opinion. What's your opinion on that?
Yeah, look, I actually had to go to the University of Hard Knocks to get my answer for this question. I'm also in the camp that less is certainly more. And again, through experience, what happened for me, I started off just investing in ETFs. I started to slowly grow into dividend stocks and, kind of one pillar at a time, building up my positions with these higher quality companies. 2020 hit, and I went on a massive shopping spree because a
Mm,
lot of the dividend
smart.
stocks were on sale. I mean, every company was basically discounted on sale. I got
Yeah.
excited because I was watching some other YouTubers out there. And, every time you watch a dividend investors channel, you see somebody saying, an X month I got paid Y amount. The following month I get another 100, this 100, And so it's exciting. And I got caught up in that. And so my portfolio from before 2020 was less than 10 stocks. After 2020, it was around 45 to 50 stocks.
Nice.
And look, they all, I think, are solid companies. But like what I say now is it's not great to receive a dividend sometimes. It's like 46 cents, right? I'd rather build up a good position in a high quality company and then get that income. But less is more here. So I heard Bill Ackman speak, and he also shared the same thought process there, where he can go down to 7, 8, 9 stocks, high quality companies, and that's what he can manage. So that was a mistake I made on my end. But based off of this, I'd love to know, looking back, what's one or two mistakes that you've made throughout your investing career?
Yeah. See, I would say, I mean, I'm such a careful investor, so it's hard. I haven't made too many mistakes. I think it's more like opportunity cost style, where had I done something with this money and put it over here instead, I would have made more money. But I can't ever sit there and say there's regret, because I still made money and still was able to diversify. So it's hard for me to say, what's a big mistake. One big mistake that I did was, the only time that I've ever invested without understanding something was during the craze of NFTs and crypto NFTs. And so my brother is an artist, and he crushes it. He's such a good artist. He's like literally makes a living doing crazy murals. But he was in this space, in the NFT space, made some NFTs, made some money through it. He was buying and selling them, making a lot of like money doing it. And so he was like, dude, here's the project that's going to be the next thing that crushes it. I'm like, all right, whatever. I'll just do it because I've never done it. And I think I invested like $1,000, bought three of these little JPEGs. And within like a week, it went down to like $4. And I was like, that is the fastest I've lost four figures in probably ever. And I hate this, and I'm never doing that again. So I would say that right there. And it's funny because I documented it on my channel too, and kind of just said, all right, my $1,000 just went to, like, at the time, I think it was like $70. And I was just like, don't do this, people.
I think that wraps right into instant gratification, right? It's something
Yeah.
we opened with. It's just like, don't want to make it's okay to want to make all the money by Tuesday, but it
Yeah.
pays to be patient, and it's all about, the longer term here.
Yeah.
I want
And
to
I think,
ask you this question. It's a little more dividend specific, but another one I'm going to throw out to the professor here. Dividend yields and chasing yield for those of us who are dividend investors, because you did have a video that came off that said living off of dividends.
mhm,
And, part of living off dividends, right, is making sure that you got a good dividend yield coming in
yep.
and supporting yourself. What's your take on chasing yield?
Oh man, here's another here's another one that I have an actual strong opinion on. Most things, it's like it depends. You'll figure it out. This one, do not chase yield, everybody. Like understand what dividend yield is first of all. If you're looking at a percentage, a dividend yield percentage, literally, if the stock is, if you have a dividend that's $5 and the stock is $100, you have a 5% dividend yield, right? If the stock drops down to $50 and that dividend is $5, now you have a 10% dividend yield. That doesn't necessarily mean that the dividend yield is amazing because it's still the same amount of money you're actually making. It's just that the stock is doing terrible. So if you're just chasing that yield at that time, if the stock goes back up, the yield's going to drop. And if the stock starts to die, you're going to lose money on your investment in general. So all that to say, if the only thing you're looking at is the yield percentage, you're in for a world of hurt. Most, you know, covered call ETFs or some of these ETFs that they're building out that have 10, 20% dividend yield, they sustain that for about a year, if that, and then somehow the whole thing just dies. Because if you think about one of the questions that you asked before, which was, what do you like about a company that pays a dividend? It's because they're able to pay a very small portion of their balance sheet, the extra cash that they have to allocate towards investors, but they're literally giving up part of their profit that they could use to build the business bigger. And so if they're paying out too much of that, the business can't continue to increase their competitive advantage or their research and development or whatever. And so they're being foolish with their money, giving out too much to us, and we're spending that money, and it's just not smart. So, all that to say, don't chase yield. Please listen to the things that Ari says on his channel and the ways that he's looking at certain specific companies. In my video where I talk about living off dividends, I don't think I have a dividend yield that's above 4%. I think all of them are pretty safe, boring investing like the rest of my investing. But the way that you're going to live off of dividends is putting more of your money into good dividend stocks that hopefully have a good CAGR dividend growth rate and continue to grow, and you let that compound interest take over.
There's absolutely not a shot I think I could say anything better than how you just phrased it all. So I appreciate the answer. I almost knew that one was coming just because I've seen some of the videos of yours.
Yeah.
Nolan, I'd love to know, macro wise, man, we are living, I mean, I'd hate to use the word unprecedented, right? But it's been an unprecedented, few years here. And right now in the macro environment, right, we did have inflation come down to 3.2%. We have the Federal Reserve that's still rather hawkish,
Mhm.
probably holding those rates up for probably I would say 2024 until 2025. And I'm
Yeah.
curious to know with your investment side, I mean, I know it's ETF investing, but
Mhm.
you're a professor as well, and you probably have that macro lens. I always say macros matter. I want to get your take on macros matter, and should they go into someone's, investment thesis? Should we just disregard macros? And it's totally okay to say that macros don't matter, but I'm curious to know your answer.
I would say macros matter. I definitely would say that. I think that sitting there and saying that we should disregard anything is probably not the best way to do anything. You can't just like sweep it under the rug and say, well, that doesn't matter to me, right? Like, I think that you have to take in all the data, all the information. You have to take in the news, even though a lot of it's hype, and just know that it's happening. I don't necessarily think that you should make an emotional decision based off of macro trends or even micro trends or what the news is saying. Hopefully, you're not making investments off of that. But all that to say that I think that it does matter and you should have an understanding of it more so to be able to explain why things are happening. So if we see something happen across the world, a war or something like that, and then you see certain companies start to plummet a bit, you can then ask yourself, okay, is there a correlation between those two? And then if it happens again, then you can say, okay, I know when this happens, this might happen. And so if you are an investor that's investing in individual companies, it might be a smart move to say, okay, this is going to happen. And so the last 3 times this happened, this would be a great time to purchase, right? If that's your strategy. Since my strategy is long-term buy and hold, dollar cost average, very boring, I don't care if my ETF at the time is at the highest it's ever been. I'm still going to buy in if it's my dollar cost average time to buy in, specifically for the S&P 500. If it's literally the highest it's ever been, PE ratio is the highest it's ever been, I'm not worried about it because it's been the highest it's ever been every couple of years for the last 70 years, right? And then it keeps going higher. So all that to say, I do believe macros do matter. It's something that you should understand and be educated on, but I don't think that anything emotional should be swaying the way that you invest.
Fantastic answer. I love it. I couldn't have said it any better myself. Heading into 2024, how should we kind of strategize, whether we're beginning to invest or a little more experience with investing? Are you doing anything to change up your game plan, or again, you're just going to keep doubling down in dollar cost averaging?
I personally will be doubling down in dollar cost averaging, but I am at a place where I've done all the steps that we talked about before, where I have my safety in place. I don't have debt. I don't have consumer debt. I don't have, I do have an emergency fund. I do have a substantial amount in a high yield savings account for a rainy day, just in case. I do believe that people need to take those steps more serious over the next year than they have had to over the last 10 years. We've been in a bull market. We've been in a very easy place to live over the last 10 to 12 years. You throw your money in the stock market, it's probably making money. Nowadays, you have to think a little bit because if you need that money in the next year to 3 years, there's a possibility that thing drops. Like you put it in the S&P 500, I don't necessarily think that it's going to be up in a year from now. I'm still putting money in, but I just tell people, like, if you need that money, this is not the time to be putting it into the stock market. If you need that money, that should be somewhere liquid, somewhere that you can access that money. So for most people, I think you really need to solidify steps 1 through 3 kind of that we talked about. And if you have that, then this is a great time to be investing. I think there's going to be some sales. I think there's going to be a lot of dips. And I think that people who are ready for it are really going to come out strong. And in 2025, 2026, we're going to look back and say, man, I wish I would have bought more in 2024. So all that to say, over the next 3 months, people, do your best to get out of consumer debt, do your best to increase that savings account. Just throw it all in there, do whatever that needs to do. Like if you have to eat top ramen for a little while, do it. And then I promise you, through 2024, stay strong with the investments you see, and that you research yourself and that you just figure out that are good for you. And then I promise you, 25, 26, we're going to be happy.
The ramen noodles will pay off.
Yes.
Now, I got my favorite question here that I ask all the masters that are on Masters of the Market. And typically, what I like to do, because I'm so generous, is gift each and every one of you with 10,000 virtual, non existent dollars for you
Sweet.
to invest in any one individual stock. So I know you're an ETF investor, but if you had to throw it into one individual stock, which
Yeah.
stock would it be and why?
Thank you for the gift, first of all. Very happy to win this award. Yeah, it's a toss up to me between Berkshire Hathaway and Microsoft, to be honest. I have researched the crap out of both of them, and I just believe in both of their journeys. And I believe 10 years from now, both of them will be in a place that is hard to comprehend at this point. But I do give a slight edge to Microsoft just because the AI and technology boom that we're about to see is nothing compared to what we just saw. I think that there's been some hype, but no real basis, no real legs underneath the AI. Like ChatGPT is the pinnacle of AI at this point, and what people can do with cool like graphics. That's nothing. That's like back in the day saying the whole internet is like email. Like that's such a small piece of what eventually can happen with the technology that's being figured out at this point. And so once we get our microchip situation figured out, once we get AI to start being able to really solve problems that need to be solved, it's going to be a whole different world, and Microsoft is at the front of that. So that, along with the fact that they also have a sustainable competitive advantage in very boring things like their Microsoft products, right? The Outlook and Microsoft Word and just software that the government is using, right? Like it's just such a safe company on both sides. Plus, having a balance sheet that's immaculate. Like there's just no place on this company that I'm like, but maybe not. No, I really think this is going to be a big one. And the last thing for you that's exciting is their dividend growth, right? Like they eventually could be a dividend aristocrat, dividend king at some point. Their dividend growth has, been quite substantial over the last 10 years. So
Sure. Great answers, great companies. Now, investors, thank Nolan here for joining us on Masters of the Market. Nolan, I hope to have you back on within due time. You've certainly been a very knowledgeable guest that we've been able to have on here. I'm very grateful to have had you on Masters of the Market. And investors, until next time, we will see you all there.